Hello everyone and welcome to This Week in the Market. In this week's update, we'll discuss the upcoming European Summit and the RBA's rate decision meeting next week, and then we will talk about the natural gas market and why we think the prices may have bottomed. So leaders of the 17-nation euro area would meet today in a summit which will finish late on Friday. There are three main agendas for this meeting: a stronger banking union, a stronger fiscal union, and measures to help stimulate growth in the Eurozone. The banking union is probably the most urgent out of the three because contagion from Greece is spreading to banks in the euro area. Currently, the most popular idea is a form of deposit guarantees to avoid a bank run in countries where banks are becoming increasingly insolvent, for example in Spain and Cyprus. A fiscal union, on the other hand, will be one that is harder to implement because it involves countries giving up a large chunk of their sovereignty to form a coordinated government and increase oversight of fiscal policies such as budgets and spendings. This is also a reform that will take years to accomplish, so we do not expect an instant transformation after this meeting. The third agenda is to increase pro-growth measures, and that is probably the most probable of the lot. The big four countries in power, namely Germany, France, Italy, and Spain, met last weekend in Rome and agreed on a 130 billion euros package to help revive growth in the Eurozone. The Italian Prime Minister Mario Monti also said that the European Union should be adopting a pro-growth measure worth about 1% of the region's GDP at the summit, so we expect something to be done in this field. Overall though, we do not expect this summit, being the 19th one and still counting, to be the meeting that ends it all. However, markets are very pessimistic nowadays and are accustomed to expecting the worst outcomes for every event. So as long as the summit leaders could at least agree on a roadmap for the Eurozone, that should be a relief to the market and help to ease some risk aversion. Next Tuesday, RBA will meet again to decide whether they will continue dropping or will hold the target rate in Australia, which is currently standing at 3.5%. Economic data from Australia have been quite positive last month, with the first quarter GDP being higher than expected at an annual rate of 4.3%, and employment also rose quite sharply above consensus. On top of that, the increase in home loans in April did not slow us down as people have expected, so that is also a positive sign. All in all, we expect RBA to hold its rate steady for this month, after having already cut the rates for 2 consecutive times and took target rate down 75 basis points. This should be good for the Australian dollar if they hold the rates, and may even help the Aussie US to extend its rally after rebounding from the parity level. Natural gas price might be bottoming at last after 3 years of downtrend. Now, calling a bottom on natural gas is quite a tricky one because all those who have tried in the past 3 years have failed pretty miserably. Nonetheless, there are some positive developments for the sector, and we are finding it to be quite attractive at this time. Firstly, we have from the demand side, there has been an increase in utilities companies converting natural gas to use natural gas as a sort of electricity generation. This requires large investment and new infrastructures to be built, so obviously it takes a long amount of time. However, as we head into the third year of cheap natural gas price, there has been an exponential acceleration in this process, and as we see in this next chart here. This chart shows the total natural gas share of the total electric generation, and if we zoom in a bit more, we can see quite an obvious seasonality pattern in this chart, and usually the peak is in August, but this year the latest data we have is from April, but then that has already surpassed all the previous highs. So if we believe the seasonality factor will hold this year again, that means August is going to be significantly higher. So that demonstrates how fast this trend has been changing. Also, in a recent report, the Energy Information Administration estimates that demand for natural gas will likely surge 21% from consumption in electricity power sector alone. So that's another reason that we think that demand is going to go up quite quickly this year. From the supply side, the stubbornly low price has forced a lot of productions to be shut because drilling activities are no longer profitable. If we take a look at this next chart over here, This is the Baker Hughes index of natural gas rotary rigs in United States. As you can see, the active rigs has declined quite sharply and is currently at the lowest level since 1999, and it's actually almost 1/3 of the peak in 2008. So we can see supplies have been tightening quite sharply in the last year and so. On the contrary, there are still a lot of stockpiles of natural gas to be worked off, but even that seems to be declining quite quickly, as this next chart will show. We see that the stockpiles peaked in late March, but that has fallen quite sharply since then. It is actually quite interesting to also note that the peak in March is just a couple of weeks before natural gas price made a bottom. So both from the demand and supply front, we think there are fundamental evidence for natural gas to bottom around these levels. Of course, this is no guarantee that it will, but if natural gas does bottom and rebound at these levels, it will be positive for drillers with large productions from natural gas, such as Chesapeake, Apache Corporations, and Ultra Petroleums. So it might be a good idea to keep them on the watch list. So that is all from us this week. We will have more market updates for you at the same time next week. Until then, on behalf of the Trading Pursuits team, we wish you a profitable trading.